Joining us now with his perspective on the latest developments about the bailout plan is Mr. Michael Spencer, Deutsche Bank's chief economist for Asia. Good evening, sir.
Good evening.
Thanks for joining us this evening.
Sure.
Could you please give us your perspective in your reaction to the most recent version of the bailout plan that was passed last night by the Senate? Do you think that this is intact, or has it been diluted?
Well, it's obviously been diluted to the extent that more additions have been made to this bill to make it more likely that it will pass, and we think that the House will pass the bill when they vote. The core of the original proposal, though, remains intact, and that is a plan to fund some agency owned by the government that will buy up to $700 billion in either bad assets or bank equity to recapitalize the banking system. So that part remains intact. We think the additional tax cuts and assistance for energy, alternative energy and the like, simply help to get the bill passed.
So that was just basically a political ploy to get it through.
Yeah.
But the intended purpose of the bailout plan is to basically release more credit into the system, help recapitalize these banks. Do you think it could really do that? And how much more can we expect to see interest rates to go down to basically push the liquidity out?
Yeah, well, I mean, this bill itself doesn't really address the liquidity issue per se. It does try to inject liquidity into the markets for mortgage-backed securities, which is really at the heart of the problems in the U.S. economy. But it doesn't address liquidity in the system, which is really what the Fed has been doing by expanding its balance sheet. So we think, yes, it will help to provide liquidity. More importantly, it'll start to provide a market for mortgage-backed securities. And the idea, in part, is to try to provide prices that people trust so that private transactions not involving the government can start to take place.
So the valuation and how the process of valuing this mortgage backs now, how do you think that's going to happen?
Well, the idea is that they're going to hold what's called reverse auctions, where the government will say, we're willing to buy $50 billion worth of these assets. The banks will then post their bids. And the government will buy $50 billion starting from the cheapest price, and so that essentially you do that every couple of weeks, and you start to essentially arrive at what the market agrees is the fair price for these assets. Now, part of the difficulty is, of course, these are very heterogeneous assets,
right.
So it's going to take a few rounds of these auctions before the market starts to figure out what sort of price everybody seems willing to accept for different kinds of mortgage-backed securities.
What are they talking about now? I'm hearing between, what, 50, 30 to the dollar?
Generally the sense is that people are holding these things sort of on average, and you've got to be careful because, of course, there's all kinds of tranches, but sort of a good BBB tranche is probably held on the balance sheet at something around 60, 65 cents on the dollar. And so the thinking is that something around there would be fair value for those relatively highly rated tranches of bonds.
Implications for Asia, sir, and our central bankers and our regulators here. What do you think is going to happen here?
Well, I think two things have to be borne in mind. This bailout bill, as I said, is designed to try to liquefy the market for the assets that are causing the worst problems and to recapitalize the U.S. banking system. It does not really address the key problem today in the markets, which is counterparty risk. It'll take a long time before enough of these assets are off balance sheets before banks really start to trust each other. So I think you should expect that these high interbank interest rates we've seen and the illiquidity that we've seen in the last few weeks, that will continue. The second key point is that really does nothing at all to address the underlying macroeconomic issue, which is a 20% decline in house prices already in the U.S., the likelihood that prices will fall at least as much over the next year or 18 months, the fact that the U.S., Japan, and Euroland are in recession and are likely to stay in recession. So the implications for Asia is that international credit remains frozen and will be for another few weeks at least, and that our major export markets are in recession.
So, now here in the Philippines, we basically have this big flow of OFW remittances from overseas Filipino workers.
Yeah.
Do you have a perspective on that? Do you think that that would be secure enough to basically prop up this economy?
Well, I think so. I mean, I think one should expect that the growth in remittances will slow down somewhat. But if we look back in time, even in past recessions, in 2001, remittances held up well. So I think, you know, it's natural to assume that there's going to be problems on that front. But actually, I think what we'll see is remittances hold up. To some extent, as times get bad around the world, people tend, if anything, to send more money back home. So I think remittance growth probably slows down a little. but the volume is now so great that it really does provide a very strong support for the economy.
Okay, let's just look at the region, sir. If you were to advise somebody on where to go, what to invest in, what markets here in Asia would you be looking at?
Well, I think I'd start that by saying that overall, I think this is not an environment to be in equities, to be perfectly frank. I think it's going to be 3 to 6 months of generally declining equity markets in Asia. Earnings expectations, in our view, are still far too high. With that, having said that, on a relative basis, I think you'll find safe haven in China and Indonesia. The markets we would want to avoid would be Korea and India as markets that we think are just far too expensive at the moment.
China and Indonesia?
Yes. Indonesia and China historically very uncorrelated to the global cycle, so while they will slow down, they will slow down less than others. And I think over the next, say, 3 to 6 months, that'll be very important for investors to try to find countries that don't look really exposed to the global cycle. Philippines would be probably next on the list, to be honest. And then the other extreme, you have Korea and India. Korea, a highly cyclical market with serious illiquidity problems at the moment of its own, and India, a market that we still think and have for some time felt is very expensive. So in the context of generally declining markets, you'd want to be overweight China, Indonesia, Philippines, and underweight Korea and India.
Korea and India. Okay, thank you, sir. That was Michael Spencer, Deutsche Bank's chief economist for Asia.
And that's Business Tonight. Join us again at 9 tomorrow. I'm Ron Cruz.
And I'm Ninfa Bito. For your feedback, email us at businessnightly@abs-cbn.com.
Thank you for watching. The World Tonight is next.